After last Friday's NFP report, let's just say that we're pretty much one down and one more key item to go before the FOMC meet later this July. Hello, everyone. Month here, market analyst at IG. Let's go ahead and get started because we got ourselves a lot to digest. I know it's been pretty much about the labor market late last week. We had ourselves non-farm payrolls, 209,000. Though you take out the 60K government jobs, you then add in factor in the 110 lower revisions for previous months, and you're looking at a pretty weak reading, not to mention the fact that this is the first miss after 14 consecutive beats. So I want to say that's slightly highlighted there in red in the sense that it was definitely seen as a weaker report. But then you take a look at some of the other components that were there. Unemployment rate lower, 3.6% from 3.7%. U6 though, the underemployment rate rising from 6.7 to 6.9%, and wage growth higher than anticipated, 0.4%. Its previous revised higher, and then you got year-on-year reading of 4.4%. So in real terms, positive if we're taking a look at the most recent CPI headline year-on-year reading, which we are going to get to afterwards. Then you get the labor force participation as well as the employment population. No changes there, so as is. You look at, I guess, when it comes to the markets and the relief that we saw, we're going to pull up Nasdaq 100 just a moment, but I guess everyone was pretty much happy, especially on the bond market front after the volatility that we saw on Thursday, that it wasn't ADP's 497K shocker print that would have definitely boosted rates and briefly did boost rates or market expectations in terms of rate hikes out of the U.S. Federal Reserve. Challengers job cuts was lower, but then again it is summertime and usually you're anticipating lower readings, but it was much lower than the heavier readings that we saw prior. Job openings was a miss back beneath 10 million, though its previous was revised higher, and then it continues claims, which dropped to 1.72 million, and then ISM services employment component, where it actually went into expansionary territory. So overall, you look at the whole picture, no doubt. I mean, we've been going through weeks, if not months, of this where we had weak points within the data, and that's pretty much been the story when it comes to U.S. labor market. But overall, still considered pretty much strong in the sense that markets are still pricing, courtesy of Refinitiv, still pricing in a final 25 basis point rate hike. I want to say via significant majority, gets around 90% when it comes to their meeting in July, and it's leaving the door open, but still a significant minority, let's call it that, on getting another increase to another 25 basis point increase after that. But essentially we're looking at 5.25 to 5.5%, but then staying there until at least May of next year. So that's kind of where we're standing right now, unless of course something significant happens between now and then, in the sense that we're looking at a significant shock, or if for whatever reason we are going to be seeing some sort of significant difference when it comes to pricing data. And this is the reason why the next big one is what we've got, US CPI, Consumer Price Index. Here we're looking at month-on-month growth. When it was for May, this was released in June for the month of May. It was 0.1%. It was year-on-year headline was dropped to 4%, and you had core still sticky month-on-month at 0.4%, and so too the year-on-year reading at 5.3%. Let's take a look at the Cleveland Fed's inflation nowcast. This is for June, so the releasing that we're taking a look at, I've chosen to look at their estimates in this case, and CPI both month-on-month headline and core looking at growth of 0.4%, whereas look at the year-on-year headline for CPI. It's expected to drop to 3.2%, whereas the core, as always, problem child, it's the coffee that wasn't made right, dropping from only 5.3 to 5.1%. But here's the thing, I know a lot of people are looking at if you look at just the headline, that's seen as very, very significant, going, 4%, we're going to go into the 3% handle now, and 3.2% at that. Doesn't mean we're getting very, very close to the targets for the Fed's 2% target. Well, in this case, though, obviously we're going to be noting core. And then there's the other matter that it was last July when we got the readings for June of 2022 when we had that 9% plus, it was around 9.2% reading headline figure, and since then we've been essentially working off of base effects to help lower this figure. No doubt the month-on-month readings, of course, have been lower, so that's obviously been a plus, but we've always been looking at month-on-month figures of 0.1 to 0.4%, which means kind of averaging out above what would be a year-on-year reading of 2%. So if we can no longer rely on those base effects, you look at the estimates for July. I know we're still in July. We're not even at the midpoint of the month, but the estimates for July from the Cleveland Fed's inflation nowcast looking at an increase from 3.2 to 3.6%, and for the core to actually rise from 5.1 to 5.2%. So I know people are going to there's that cheer over the year-on-year headline for June getting to 3.2%, but now comes we're anticipating bumps at this stage, and that's why we're going to have to be focusing a lot on those month-on-month readings to ensure that they're not that high. They need to stay within 0.1 to 0.2%. So that's US CPI, and then afterwards you're going to have on Thursday, you're going to have producer prices. You got trade pricing data, the usual trio, and the preliminary readings, U of M's consumer inflation expectations for both the 12-month and the 5-year. Hopes are that it'll at least stick at these levels, because the numbers that we saw, the drop that we saw last time, that was quite significant. I did point that out in previous videos, and the hopes are that can manage to stick, or maybe even go lower than those figures. Otherwise, on Friday, we got ourselves earnings from financial heavyweights. These are a lot of those that are releasing, less exposed on the deal making and investment making front. So the numbers aren't expected to be as bad as what we're supposed to see at the start of next week when we look at Goldman Sachs, Morgan Stanley, so on and so forth. But at the very least, there's the note of their outlook, their lending outlook. We do know the credit conditions are supposed to tighten. Net interest income, especially in the face of what have been a significant amount of flows going into money markets. I mean, a significant amount. So they are competing on that front as well. So even if there's a nice gap between what they're offering to clients and what they're getting, at the end of the day, there's still the matter of whether or not there are enough clients that are willing to take at that rate, and especially in light of what we saw since the start of the year and post SVB, so on and so forth. These are for the larger institutions, so clearly seen as too big to fail, regardless of what numbers we're supposed to be getting. But then on a global, looking at it more globally now, looking outside the US, we did get some Chinese pricing data this morning. CPI figures, not just a miss, but lacking any increase. And producer prices, what is it, negative, crossing worse than expected. We're looking at down year on year more than 5%, which I guess some would look at that and say it's a plus in terms of exporting deflation, but it's a negative in the sense that many were anticipating that they were looking to China and the reopening trade as sort of boosting demand and helping keeping things afloat. And if that's not the case, that means they're going to be exporting deflation, or at least as we saw prior, where it wasn't a matter of them during the trade war, it wasn't a matter of them trying to sell their goods in other markets. It was more like liquidating and trying to sell it at any price, just because at the time the situation was very tested. And it's very similar to what we saw back then, in the sense that manufacturing sector was in a recession. We are in the same situation now, though not because of the trade war, but due to post-pandemic, the shift from manufacturing to services. So we are seeing a similar story in that regard, but that just means that a lot of times that the manufacturing sector might remain depressed for the foreseeable future. And then you got UK labor data on Tuesday, obviously looking at wage growth, given all that's been happening and given what markets are pricing out of the BOE, as well as you got a string of data on Thursday. It was construction, services, production, and month-on-month GDP for the month of May. And then we got ourselves sandwich in between that on Wednesday, we got ourselves, same day we got US CPI, by the way, we got ourselves two central bank decisions, Reserve Bank of New Zealand, as well as the Bank of Canada. Now, Reserve Bank of New Zealand, expectations are, courtesy of Refinitiv, on hold. There's not going to be an increase in their interest rate, on hold at 5.5%. They are in a technical recession, and this is after they signaled a pause the last time around. But for the Bank of Canada, they surprised last time around with a 25 basis point increase, taking their key rate to 4.75%. The expectation by a majority, it was around 66% last I checked, so I want to say significant majority, but not necessarily getting to the extremes or anywhere as high as, say, what we're seeing in terms of the Fed getting another 25 basis point increase, but by a majority, basically, essentially getting to 5%. Interesting to note, when it comes to trading, that on the COT speculator financial institutions, looking at this case, that they shifted when it comes to Canadian dollar last week. It's released last Friday, positioning as of last Tuesday. They shifted from slight sell 51% to slight buy 53%. Similar story when it comes to New Zealand dollar, by the way. They were slight sell around 52%, now slight buy around 52%. And I just want to pull up IG's trading platform just to look at what we saw last week in the sense that, you look at it and you think to yourself, this is the daily chart. You think, okay, we're looking at a bit of a pullback here when it comes to the Nasdaq 100 or US Tech 100. But you zoom out to the weekly time frame, hardly a dent when it comes, and that's the reason why the technical overviews for US indices so far on the weekly time frame unchanged. Yes, Europe was hit harder, and that means that we did see some moves over there, especially when it comes to the daily time frame. A lot of the technical boxes. Speaking of technical boxes, we're looking at this is today's report. You can find the link of this in the description, but pretty much what we've discussed here and a whole lot more. It's going to be released in the report, and you are going to have the technical overviews. We do have the majors, but USD CAD, NZD not here, but that's the reason why I shared their sentiment ahead of time. But with that in mind, I want to thank you guys so much for watching. Good luck out there, and happy ticks.